To stay on this one, President Obama once again taking aim at the banks. He just wrapped up a speech where he proposed stricter regulation on the banks. Joining us now, Mark DeCambry, Wall Street reporter for the New York Post, Erica Payne, senior advisor at the Roosevelt Institute. Though, I want to start with Peter Barnes with the latest from inside the Beltway and the vocal rule. I guess I can't even say it straight, as the president called it today.
Yeah, that's part of it, Cheryl. The president stepping up his attack on the nation's financial firms with two new proposals to limit their size and some of their riskier but more profitable activities. Former Federal Reserve Chairman Paul Volcker leading this effort through the Presidential Economic Recovery Advisory Board. What they are proposing is to reinstate some of the provisions, some of the ideas of the old Glass-Steagall Act. Congress approved Glass-Steagall in 1933 to force commercial banks to spin off their investment banking operations after the Great Depression. So, for example, J.P. Morgan spun off its investment banking division, which became Morgan Stanley. But in 1999, Congress repealed Glass-Steagall, and that triggered a wave of consolidation in the financial services industry that some say laid the foundation for the recent financial crisis. Now, in the first new proposal, I'll read from the press release, this so-called Volcker rule, Cheryl. The president said it would ensure that no bank or financial institution that contains a bank will own, invest in, or sponsor a hedge fund or a private equity fund or proprietary trading operations unrelated to serving its customers for its own profit. The second proposal here from the press release, quote, would limit the consolidation of our financial sector by placing broader limits on the excessive growth of the market share of liabilities at the largest financial firms. Now, the president said just moments ago that he is ready for a fight with the financial services industry. Take a listen.
If these folks want a fight, it's a fight I'm ready to have. And my resolve is only strengthened when I see a return to old practices at some of the very firms fighting reform.
Now, this is just the latest proposal in a series that we've seen from the president just in the last week or so. As you recall, he last week proposed a $90 billion fee tax on banks to help recoup projected losses in the TARP. And then just this week, he got behind in a big way this idea of creating a consumer financial protection agency. Now he's adding these two new proposals to the legislation that is moving through Capitol Hill. Plans to work with Congress to try to make it law. Cheryl, back to you.
Peter, stay there. I want to bring in Mark DeCambry, Wall Street reporter for the New York Post. Also, Erica Payne is with me, senior advisor for the Roosevelt Institute. And Erica, I want to start with you. You and I had a very heated debate about a week ago about the fees on banks. I know you're smiling. Do you think you must be thrilled that the president came out with this today?
I'm absolutely thrilled. This is the President Obama that swept into office a year ago. I've been wondering where he's been, and I think here he is. This is a Rooseveltian moment. These are critical reforms. They're not the only things that need to be done, but this is absolutely a fantastic day for the president and for the financial sector, incidentally, but most especially for American business.
Okay, Eric, it's not a great day for financial stocks right now. We're seeing a big sell-off, Mark DeCambry, with the financial names in particular. What happens now? When are we going to start seeing J.P. Morgan Chase sell Chase, for instance? When are we going to see bonuses get in line with what the president wants?
Well, I mean, I think a lot of the banks right now actually just trying to figure out what this all means. This is a pretty impactful day. And, you know, when you're on the call with Goldman Sachs, you know, there's a lot of buzzing going on about what this means and, you know, are certain banks going to have to split off? It's unclear at this point. It would be hugely impactful for a company like Goldman Sachs because prop trading is integral to their business. I mean, that's a central component of what they do.
Mark, you're making a good point here. It's Liz McDonald. I was on the phone with Goldman Sachs, and we went through the numbers, and the proprietary trading, which means making bets with their own money, only represent about 12% of their net revenues.
But, it only represents 12%.
But Mark, the real key issue here is that what is at the root of the crisis? It's bad loans. Fannie Mae, Freddie Mac, Wachovia, WAMU, all melted down because of bad loans, not because of Wall Street activities. And I think you might agree with that. You don't see Fannie Mae and Freddie Mac being hauled before the PAYSAR or before the Financial Inquiry Commission. And what's going to happen is this is one of the most misguided attempts at financial regulation we have seen out of this administration to date, when they're forcing them to put back on the balance sheet off-balance sheet assets. You may see that activity pick up.
Mark?
Well, we'll still need to see more clarity on what this actually means. But although this only represents, prop trading represents 12% or so of Goldman Sachs' overall business, it's pretty central to what they do from a mediator standpoint. This is what they do for their customers.
No, you're talking about trading overall. We're talking about something different. Yeah, trading overall, Cheryl, is about 76% of Goldman's net revenues. But when we're talking about their own skin in the game, which is what the administration thought it was going to attack first, it's saying it's not. It's only about 10 to 12%. But the bigger issue about hedge funds and private equity funds is a big deal. You see a lot of off-balance sheet entities at J.P. Morgan Chase, for example, hedge fund and PE-style activities.
Right.
That's
So,
stuff they come back on.
Okay, so but does this mean that the investment banks, the J.P. Morgan Chases, mainly the Morgan Stanley, Goldman Sachs, James, get out of the hedge fund business completely, or do they just rejigger their operations to still do business?
I hate to answer a question with a question, Cheryl, but somebody's got to help me out here. Obama came out and made this announcement. I read about it in the Wall Street Journal this morning about what he was going to announce. Is this an executive order? Is this a bill that's going to go before Congress? Or is this just more words the way PPIP was really words? I mean, let's be very blunt here.
All right.
There's been a lot of initiatives that have come out in the last year that have been nothing more than words. So what is the force behind this? Somebody please tell me.
Peter Barnes.
This would be legislative action that the administration is going to work with Congress on. They're going to supplement the existing financial reform bills that have already been passed by the House and are being worked on in the Senate Banking Committee. That's where it's going to be. New legislation.
All right. Look, Erica, here's the thing. If you look at what the potential future could be for banks, look, most of them have already paid back TARP. TARP with interest. Now you're talking about assessing fees. There's talk about taxing bonuses at 50%. They have changed the bonus structure. I mean, what more do you possibly want from the banking system when they have already paid their dues to Washington in the last year?
It's a great question. What I want from the banking system is for the banking system to do what the banking system is supposed to do, and why banks receive a charter from the government to do their job, which is to create liquidity for businesses and for individuals. And so this is just saying that they're going to take that activity and continue to have the banks do that activity, but they're going to separate out the risky activity that led to the financial collapse.
But Mark, you have to have some risk. Not all risk is bad. Just like Mark DeCambry, not all derivatives are bad. And
Absolutely.
I've had many traders, and Erica, you and I talked about this last week, I've had many traders tell me, look, I don't mind transparency in the derivatives market, but don't completely stomp out the market. And Erica, real quick, that's what I'm concerned is happening here.
So Cheryl, here's a number to think about. In 1997, the financial sector had leverage of about 64% of GDP. In 2007, it had leverage of 112% of GDP. So double the amount of leverage that they had had over a decade. And the result of that amount of leverage, backed by the American taxpayer, is a really risky and systemically problematic banking system. And so we've got to have a great banking system so that we can build businesses and put people to work. But these kinds of leveraged plays, particularly in the derivatives market, that these banks are engaged in, don't do any good for any American business.
Mark DeCambry, respond to that.
I mean, ultimately, a lot of these banks will just simply go off balance sheet and try to conduct this business on a separate basis. So, I mean, it's rules that are put up to prevent them from taking risk, but they're just going to take risk elsewhere.
Yeah.
What I'd love to say is that the things that this proposal is a piece of a lot of different things that need to come together. And so this is a great first step. There are lots of other steps that need to be put in place.
There's been plenty of steps, Erica. That's the point that
there have been some steps. There has not been meaningful reform yet in the financial sector.
But, Erica,
Barney
and also Cheryl, the real key here is the issue is bad loans and bad housing policy out of this government. And the issue is, are banks really using deposits to make risky bets, or their own skin in the game, or their own money that they make? And, a lot of banks will tell you, no, they're not using deposits to make bad trading bets. They're not. They're walled off.
No.
So the question about the bad loans is a really important question. I just want to address it.
All right, we're going to tell you what, Erica, we're going to do that. I want to take a quick commercial break. We're going to continue this discussion on what is happening in the financial sector. Once again, you've got the Dow. We're off session lows, down 178, but the big names are certainly a big problem today on Wall Street, and they really